Hello, everybody. Thanks for joining. It is just after 6 o'clock Pacific time, and it is time to turn this volume off on this monitor. Thanks for joining. There we go. My monitor still had the volume on. Now we're good. All right, we have two big topics today. We have the S&P 500 ratio and what's called the price earnings multiple, and we have another one I just added on, which is on reading your monthly account statement. It's very short. The account statement section is short, but I added it on because just recently people have been asking me to look at their account statements with them. And I see I have a bump in monitor. I bumped myself doing a chin up. I did a chin up on a crooked branch. It was dark. Bammo, got myself, but I'll be okay. I'll recover. That was yesterday. That's what I get for living, as I say, a clean, healthy life. All right, here we go. Let's get to the presentation. It was on. I don't see it. We'll get it back on. Here we go. Let's get it to page one. And I hope everybody's great out there on a Monday. And if you're watching this later, whenever you may be watching it, here we go. Page one of our presentation. Let's see it pop in here. I'm learning to use my streaming program. I just had this up. I was just watching it, and then when I came back to this screen, it wasn't in there. So there's some learning definitely in order for me. It's coming. It's good test of our composure here. Let's see if we have it yet. Okay. Looks like we might have it. Yeah. And then we can go to full screen. And after some ado and some delay, I think we're there. All right, here we go. Isn't that beautiful? The beautiful coast. And let me make sure we're still streaming here too. Yeah, we're good. All righty. Here we go. All right. There is some latency on my monitor. I will make sure that you guys have me up, and if not, I will go back and get it. So right now, we should be seeing the first line very soon of here. I'll do a signal to myself. That signal will let me know if in my monitor whether you guys can see it or not. If not, I'll get it going. No, you don't have it up there. So hang on. I can do this. I can go back in my streamer, get rid of some of these other scenes. Maybe I was in the wrong scene there. Try this one. Dump that one. Dump this one. Keep life simple. There are different scenes, and I'm deleting them to save memory. And I should be able to, let's see here. There's some latency. Sorry about the delay, but hey, it's all part of the learning process on this thing. Okay. Try this one again. Not deleting. Close this. Turning off more programs. And I think maybe we're there. Let's see here. I don't see it. Oh, getting close now. There we go. We're up. All righty. Okay, now I can full screen this. And we can get through our presentation. Let's see the full screen button on the application. Didn't get it, but we'll get it. Yeah, so I'm learning that when you're trying to run several applications while you're streaming, well, then it's putting a load on the computer. Here we go. Now we have the full screen button going. I have a feeling any second now it's going to look good. I hope so. Fingers are crossed. There we go. And when I see that we're all on full screen, and we are, okay, we'll get this show started. Here we go. So there is beautiful Carlsbad, California, that I love to share about. This I will call alpha lesson number 1Q20-1, meaning first quarter of 2020, the first lesson, because the first show was the blast off show. It was an introductory show. This will be real work, and hopefully in a way a lot more fun and enjoyable, because I was just going 100 miles an hour last time, trying to let everybody know kind of who I am and my plans for the next 500 years. And now now I can get into this topic. Here we go. So this is the price earnings ratio and its earnings growth implications. Okay. Why do I pick this topic for today? Because we are at very high levels in the markets. Okay. And so this is a way of thinking about whether the levels we are experiencing right now are reasonable or not, or if they're sustainable or not. Okay. We're going to come back to this. I'm just going to warm you up with monthly investment statement and let you know that several people have been asking me about this, and I'm going to go just through the summary on this pretend statement that I found online, but I'm going to come back to this at the end of the show. So for those of you who want to have a look at this pretend statement summary and what's on there, there's a lot of information just on that first page. We're going to go through that, including that pie chart that you see on there. We'll take our time. We'll really explain what the stuff means on this statement. Okay. All right. So those will be the slides. We'll come all the way back to at the end. Here we go. Back to the beginning. Now let's get into the price earnings ratio. Okay. Here we go. The U.S. stock market is really at record highs, and we'll see the ratio also is at record highs. I won't remember the number. It's in the above 3,000 level for the S&P 500 index, and for the ratio, it's in the 25-ish level, and we'll see that on charts. So now let's learn something here. Don't forget this. The value of every stock ever in history is based on expected future profit. Let's say you're buying a restaurant, and the guy selling you the restaurant says the expected future profit of the restaurant will be zero forever. What will you pay him for that restaurant? Not a penny. Okay. Then if he starts to tell you, well, no, there will be some profits, that's what actually the value of the restaurant really is. It's the profits. That's net of all the costs. Okay. Net earnings. Okay. And the S&P price earnings ratio that we will explain, it's a ratio. S&P is an index. S&P 500 is an index. And the ratio compares the value of the whole stock market. That is the value of those 500 shares that the ratio tracks, divided by how much they've earned for a year. Price on top of this fraction, if you're a mathematician, on top of earnings, trailing 12-month earnings. Okay. What it's measuring then is a proportion of, okay, how much did it make in the last year, and what are people paying for this? And what happens is, for stocks that people expect to grow a lot, like maybe Facebook or somebody like that, that price earnings ratio tends to be a much higher number. For stocks that don't have crazy growth in them, maybe something very steady like an electric company whose growth really can't be expected to be too crazy because it's based on how much electricity you consume and the size of the population, that kind of thing, then their price earnings ratios are going to be lower. So many industries have sort of conventional price earnings ratios. We won't go into too much detail about specific industries or specific names like Facebook. That's not what we're talking about today. Today it's just broad, big picture, the entire stock market, not individual names, not individual sectors. When the ratio is low, okay, maybe though, if the ratio is really lower than it has been on average, well then maybe stocks are not that expensive. If we think the ratio is unreasonably low, well, maybe it's time to buy stock. And vice versa, if the ratio is high, maybe it's time to be scared, and that could be where we are now. In fact, that is where we are now. That's why I chose this to be my first actual lesson in the series of the Get More Alpha show. So did I introduce myself? I'm Al Mora, host of the Get More Alpha show. I'm getting used to being a host of a show here. So I'll be starting off my shows with my name from now on, I think, if I remember to. It's in my notes, and I didn't do it. Okay. So anyway, here I go. I say the ratio implies future earnings growth right there in red. And in this lesson, we will evaluate whether the ratio's current level and implied earnings growth, we'll use that to assess prospects for the future. Now, we're going to look at our roadmap. We're going to do a summary and conclusion. We're going to look at S&P Global, the company that is the author of the S&P index, S&P 500 index, and of the price earnings ratio. They don't, I don't think, publish that ratio. Investors everywhere just calculate the ratio. I don't think Standard & Poor's calculates that ratio. Okay. And then I will explain the S&P 500 index. I will explain what market capitalization means, because that's the number on top of that ratio. The ratio is a fraction with a number on top and a number on bottom. Numerator, denominator, for those of you who took a little bit of fractions in school. Okay. And we'll look at what 12-month earnings, how they're really calculated. Some people have been using them for a long time, but never stopped to calculate them or think about exactly how they're calculated and why they're used in this ratio. Then we'll look at the ratio history, the actual chart of which we have here on the left is the S&P 500, and it has year ends. It doesn't have within the years. It just has the number at the year end since 1927, but it does have its last number is where we were last Friday. Today is Monday. Okay, and then we look at what the implied earnings growth are from that chart, and then our conclusion. And I don't have it on our roadmap. Then we'll come back to looking at that summary monthly account statement. Okay, so here is one slide that you can watch and you can be done. You can watch this and you got the whole show. You can skip the rest of the show, especially if you're someone who knows what the index is, who S&P is, how the ratio is calculated, and some of you could teach this class better than I could. So you can just stick around for the next, 5 minutes, get this, and you're done. For the rest of us, I'm going to walk through each piece of this and why growth is implied from this number, and even a little bit of algebra that you can skip if you're watching this recorded. Then you can just skip to a slide number that I'll give you when I start doing the derivation. Okay. So right now it's around 25 times. We use the X to say times. So the S&P 500 ratio, and if you look at this chart, you'll see, look at the chart now, that's where we are. You see the red dot that just appeared, and you see the line tracking back to our scale on the left, and you will see that we are at 25 times. Look underneath there and you'll see 20, and look above and you'll see 30. Now look at that green line for a second and notice we have very rarely been above that 25 level, very little, okay? And notice there's a huge spike that happened in 09. We'll explain that in a minute. Now let's go back to our titles here, to our text here, and look at the average, 17 times. Let's look at that average on the chart. You see the red line that popped up, and you see there's a gray bar next to the line. That's the average for this period for year-end numbers, 17 times. You see 17 times popping up on the scale on the left. Now, we have been above 25 times at the end of only 7 years. Let's look at those 7 years. There's one, the highest one there. We'll explain why it peaked back in 09. You see that arrow that popped up at the top of the top peak there of the green line. Okay, and then there's another time that it happened back in late 90s. I didn't go back and explore why that is, but it has to be, the bubble. That's right. The .com bubble. Okay, so there was a big spike, and it makes sense. I'll explain why. Anyway, we're going to count our red. Let's count our red arrows. 1, 2, 3, 4, 5, 6, 7 times we've been above our current average, and we have been below our current average 85 times. You see the big red bracket. So my initial assumption is just having looked at that, we don't even have to do all the rest of this work we're going to do for the next 45 minutes. There's a bigger chance right now the market will fall than it will rise, using not just the S&P 500 index, but considering where is the price compared with how much companies have earned over the last 12 years, right? Feels like it's very high. But now we're going to do an investigation and ask ourselves something. Maybe the modern economy can sustain higher growth. Maybe we're just through artificial intelligence and people just getting more college degrees and people getting better at programming, and people running companies more professionally. Maybe we're just learning to make more money with less, and companies can make more profit with less. Do we believe that's happening? And that would mean not just make more profit, but be able to increase it a little faster, if not a lot faster, than we have for over 100 years. 27, well, that would be less than 100 years. That would be 90-ish years. Okay. Don't trust my math too much off the top of my head. I have to rely on my slides for math. I used to be good at math in my head. No longer. Okay. So today's conclusions then are, this is it. Here's my conclusion. No. Okay. We're going to get into the growth rate. And when we get into that growth rate, I think we will all get comfortable. But I'm not here to convince you. If you could disagree with me, great. Okay. Not a problem. But based on what we're going to go through here, I'm convinced that we can't not sustain 25 times. Okay. Price earnings ratio. We might be able to sustain something higher than the old average, because if we look at our chart back here again, we see that more recently, since 1990, say, it has been higher than before 1990. So maybe we're in a new world where we can sustain it higher than 17, but 25 feels too high, right? So, but if we just fell from 25 to 20, that's a 20% drop. That I can do in my head. Taking 20% from 25 gets 20. I think I got that right. And so that would be $5.6 trillion lost. Okay, $19,000 per person in the United States would be lost in the market if that were to happen. Okay, so back to our roadmap. Look what we've done. We've gotten through our summary and conclusion. Now we can move on to the S&P, and this is a quick, easy one, just explaining who creates this index, right? So many people may use things, but you don't even know where they come from. And part of being an informed investor is starting to explore and seeing what's behind stuff, because sometimes people may be giving you information and then you may learn when you know more that, well, they have incentives maybe for shading it, okay? But I don't think that's the case with S&P. S&P Global has a great reputation. They are the majority owner of a company called S&P Dow Jones Industrial. And this is complicated stuff, how companies own pieces of other companies. In fact, 3 big companies own S&P Dow Jones Industrial. We won't worry about the other 2, but the majority owner is S&P Global. S&P Global, here's why they're very important, because they own a bond rating agency called Standard & Poor's. And you might have heard of Standard & Poor's your whole life. And Standard & Poor's does a lot of stuff, but I won't be surprised if they make more money doing this. Well, maybe not, but they make a lot of their money doing this because this is what they've been doing a long time. That is, they give bond ratings. When companies issue bonds to borrow money, before they issue the bond, they go to Standard & Poor's, and they go to a couple of other authoritative entities that compete with Standard & Poor's. And they ask them to rate the bonds, and the higher the bonds get rated, the easier it is to sell them. And for the companies, the lower interest rate they pay on that bond. They even rate our treasury bonds, the bonds that are government issues. And guess what? All the public bonds that are traded in the world, they rate. While the federal government doesn't pay them to rate the bonds, everyone else does. So they get to choose who they rate. But if you're a company, they will not rate your bonds if you don't pay them. So some people worry that they rate too friendly. And there have been times when they rated too softly and gently. When we had the crisis of 07, 08, part of the problem was that the bonds that ended up crashing, mortgage-backed bonds, were rated too softly by S&P and the others that do the ratings. But by and large, they have a great reputation. They blew it humongously on that. They're a great company. So they have 22,000 employees. They produce 830,000 indices. I didn't even know that. I learned that number just because I'm creating. And they produce the S&P 500 index, and guess what else they produce? The Dow Jones Industrial Average. Okay, those are the 2 most watched indexes there are, and we've gone through bullet point number 2 in our roadmap. S&P Global, we know who they are, who S&P Global is, and we know who's publishing this index that we're going to use. Now, let's explain this index. The index tracks the value of 500 of the largest companies in the U.S., and these are public companies where you can buy their shares and you can own them. So a public company is a company that's owned by owners of the shares. Okay, and they're traded on an exchange. So anybody in the public can buy their shares and own the company, including you can go in there and buy more than half the shares, and you would control the company. You would be able to put people on the board to control the board of directors, and you could hire and fire everybody in the company. All right. And even if you only own, say, 5% of the company, there are rules that require that you announce, that you let the government know, and I think publicly you have to announce. I don't remember that rule right now. But how much you own of that company is important, and how concentrated ownership is important. And to make a long story short, the more different people who own stock, the better for shareholders. Then you don't have one party that has too much power, right? Unless they're working in to your benefit, but we won't get into that too much. That's a whole governance or agency issue, a topic for another presentation. All right, so companies issue shares of stock to raise money, and you're bringing in new partners when you're issuing shares. The first time you issue shares, you've probably heard of this many times, it's called an initial public offering. Now, very rarely, companies come back and issue more shares. That's called a secondary offering. But what really is happening is when you issue that initial public offering, typically you're at a point where you really have great plans for growing your company, but you don't have the money and you can't borrow the money to grow the company. And you're willing, you come out on TV and you make it look like you're very happy to bring in new partners, especially the first time when you're going public, because the guy running or the person running the company probably will become very wealthy very fast after issuing. However, after that, you really don't want new partners. You want to keep the company to yourself. And I'm not aware of secondary offerings. I'm sure they happen, but I've never seen one happen I didn't do any homework to find out if they've been happening recently. So what's the index price of the companies? Okay. And there are rules. You have to be a big company, and you have to have been around a long time, and you have to have had good performance recently and no big legal problems to be in the index. But notice something: if you're at the bottom of the index, then you could drop off because maybe you don't meet the requirements, and they have one set of requirements to get in and then one set of requirements to stay in, which is not as strict. So you may get in and then you may drop a little, but you can still stay in the index for a while. But at some point they get you out and they swap you for someone else who's standing in a queue ready. Companies love being in this index. It is prestigious and useful to get in this index. Your price, your stock price will probably go up. I haven't seen studies of that, but it has to be the case, I'm guessing, that just getting in the index is going to give your stocks a boost, because there must be some good news that got you into the index. If you're coming in from the bottom, you got swapped in. Okay, so the index price, though, is a tracker. It's not the dollar value of the index. It's not the dollar value of all the stocks. The dollar value of all the stocks is called market cap or market capitalization. But using market cap instead of an index would be just huge. It would be disadvantageous for two reasons. Whenever you swap the stocks, okay, the new one coming in might be a much bigger company with a lot more market cap, okay? And the one coming out of the bottom of the index might be smaller. Now the index got bigger and nobody really, for no good reason, no one really changed value, but the index changed value. You do not want an index that just changed values because you swap stocks. Okay, so that's one reason you don't use market cap to create an index. And the other problem is market cap is a gigantic, clumsy number. Right now, the index is 3,370. That was Friday. And it was around that today. Today we didn't trade. Today is President's Day, so I don't think the market traded. But the current market cap is 28 trillion. That's a massive number. And if they were quoting it, they wouldn't say 28 trillion. They would say 28 trillion, 474 billion, 375 million, 976,432 dollars and 17 cents. I mean, it would be crazy, right? So an index is a much better thing to track that you can think of and remember, and you can trade on when you're analyzing how markets are behaving a lot more easily than looking at market cap. All right. So there it is. That's what your issue one. Let's go back. Is the market the swapping issue, and issue two is the giant clumsy number issue. So solution to issue one for market cap change. Now what they do is the index gets adjusted when they bring in that new name and swap out the old name. They actually adjust the value of everything in the whole index, all the old stocks that are in there, and the new one that comes in. And it all still equals whatever it closed at the prior day, because they do it overnight. And so then the index doesn't change value unless the values of the stocks that are in the index change value. So if they will record the last day of that last stock that gets dropped, they'll record that change in value, and then they'll freeze it right there. They'll throw that stock out, put the new stock in, freeze the value again, do a little bit of algebra. It's not too hard. They used to do it by hand in the old days. And then they're off and running with a new index that didn't change. And this big number solution is you start the index at a small number. And I saw that on June 17, 1977, it was at 100. I don't know if they set it at 100 then. There's some other technicalities with the index, and I suspect they set it at 100 later than that. But anyway, at one point, if you check the price right now, it was at 100. And then that's it. After that, it's your market cap could be, and let's go back to that. The index was 100, and market cap was 21 billion, this big number. But index was at 100, a very manageable number. We're through our three dashes, we've got 3 check marks going already. What is market capitalization? Here we go. This one won't be too painful. Okay, it's the value of all the stocks in the index. I won't assume that you just know what that is. Okay, here's what it is. Let's calculate it. Let's take the first out of the 500 stocks, any one of them. Let's multiply the price of the stock times number of shares. Let's pretend there are 10 shares and they're $10 each. The value of that, the market cap of that stock is $100. Okay. Well, now you do it for all the remaining stocks, and you keep track of the values of all of them, and you add them all together, and that's the market cap of the index, all right? So the index has, I mentioned it earlier, a market cap of $28 trillion rounded, okay? So there it is. That's what market capitalization is. Let's look at what a trailing 12-month earnings is, okay? TTE, we call it, because trailing 12-month earnings is a mouthful, especially now that I have mild dementia and can't even speak clearly all the time. Okay, so TTE equals the company earned in the prior 4th quarters, trailing 12-month earnings. And it's more current than prior year earnings, and we're going to see why. Prior year earnings, if you think about it, let's say that we were in December of last year. Prior year earnings would be what that was 2019. prior year earnings would be what we earned in 2018, but by the end of 2019, that's a stale number, right? So trailing 12-month earnings solves that issue, okay? Here's what we go. Let's look at any company and let's make up earnings, okay? So in 2018, the first quarter, okay, let's go back in time. So let's say this company made $1. Let's call that A, okay? And then in the second quarter, now the first quarter is the first 3 months, the second quarter is the next 3 months, third quarter is the next 3 months, fourth quarter is the next 3 months, okay, of the year. So now we're in the second quarter, this company's doing great. They made twice as much. $2 in the second quarter, we're calling that B. You'll see why. I'm giving them a letter. Third quarter, they make $3. They're on a roll, man. And in the fourth quarter, they're making $4. So take a wild guess. If you're an instinctual investor, what are they going to make in the first quarter of 2019? Yes, you guessed it. They made $5. But notice something. Let's go back to the fourth quarter. We did not know yet. Even though we're at the end of the fourth quarter, December 31st, we don't know what trailing 12-month earnings are because the companies don't report their fourth quarter results until several weeks after that quarter ends. So it's in the first quarter that we finally get to learn trailing 12-month earnings, and we go and we don't include the first quarter of 2019 because we don't know that yet. So what we do is take A plus B plus C plus D, okay? Because those are in the past, and then each quarter we move it forward. Now we take B, we skip A, drop it, take B, C, D, and E. B plus C plus D plus E, and they are on a roll because their trailing 12-month earnings in the first quarter is 10. Now it's 14. Now it's 18. And this company has $22 of trailing 12-month earnings. They went from 10 to 22. They more than doubled earnings. And had we not used TTE, we would still be saying that prior year they made $10, but they didn't. They made $22 per share, by the way. So that's why TTE is valuable, because it's current. It keeps up as much as we can. It takes advantage of information as soon as we get it. So we're done. We know what trailing 12-month earnings are. Okay, let's get into the ratio, the S&P 500 ratio. First of all, we have to start with the S&P 500 index average return. Now, let's look at the index for a half second. And what we see in the blue line, let's look at the chart. On the left is the index. And left to that is how much it's worth, market cap. If we were at 3,500, we would be at 29 trillion. Don't worry about the scale on the right yet. That's for something else. We're just looking at the scale on the left. And let's look at something. Back in 99, the dot-com bubble blew, exploded. It popped. That's what bubbles do. They pop. It popped. And, I said it burst here. I should have said it popped. Anyway, do bubbles burst? I guess they burst. It alliterates. Okay. So it burst, and by late 02, or that should be mid 03, I guess, is when it hit bottom. And then it climbed back up into 08, 07 and 08, and then it crashed during the 07, 08 financial crisis. And so our average yearly return, okay, average yearly return, that is how much did we make investing in the S&P 500. These are great numbers for you to see. From 1927 all the way until the end of 2019, you made about, let's round these numbers, about 8% average per year. And from 1945, the end of World War II, when you could think of the world as being more modern and we were past the Great Depression, we've made about 9%, okay? But look at this, in the 2000s, we've only made 6% because we got destroyed in the 07, 08 crisis. That blew us away, okay? So that shows. And then from 09 to 19, we're back on track. We're making 9% per year. That feels a little bit more normal, but look at this. In the last 3 years, 13%, and that could be too much. Okay, excuse me. Sip of water here. And so, so that's what we're going to look at, is look at that steepness of that curve as we go all the way up to where we are now. Okay. All right. So now here's what I use, and here's what a lot of people use in investing. A way of thinking of the stock market, if you really want to think of it in a reasonable way, looking at all this information, is that 10% is a great number when you think of what can you make investing in stock. It's a nice round number. And it's a number that, to me, intuitively just makes sense. Because if people made more than 10%, and 10% is a bit high, but it's to the credit of companies that they were in that range making 10%. But if we made more, think about it. Would that be fair? Would it be fair to for people to make 10%, who just put money in an account and go to sleep and forget about it? Do you know how fast that would grow into humongous amounts of money if it were more than 10%? Just huge. So 10% is a good working average. Less than 10% could be reality, but 10% is taking into account maybe the world we're in, which is that we have this modern economy with economies around the world learning to become more modern, more people graduating college, more professional management, more efficiency every which way you look at it. Okay. And a lot of it even driven by things like artificial intelligence, right? Okay, now let's look at earnings. Remember, we learned what trailing 12-month earnings were. Now, see, this is why we did our homework, because now when we look at this line, we see something, right? Forget about everything else in this chart. Let's focus on that dip. So in '08, you see that real sharp dip? That happened because during '07 and '08, earnings went way down. And notice, even though the S&P 500 went down, earnings went down a lot more, okay? So now what is the ratio again? Let's look at the ratio. Here comes the ratio. We have price, the index, we have earnings. And by the way, these earnings are translated into what's called index points. It's not the actual dollar earnings, okay? That's algebra that you don't need to worry about, but it's the correct numbers. Here's the green number again. Let's go back to remember something, okay? Okay, let's do something here. Let's remind ourselves of something. Okay, green. Green is our S&P 500 ratio. That's all I want to do is remind us of that. Okay, let's get back there. So it's just a reminder. Green is the guy. The other guys are other guys. But we're back to this. Okay, so we're at the ratio. And remember we saw that pop in '09? And look what it does. It happens right when trailing 12-month earnings dipped. So let's look at that. S&P fell 40%. That's the index. But the trailing 12-month earnings fell twice as much, 80%. What a blow to companies. And that's why the ratio skyrocketed, okay, up to 71. That's actually where its highest level ever was. I wish I'd put that on the chart because the highest level was 71 or 72, somewhere in there. So that's it. We've looked at the ratio history. We are flying through our roadmap, right? We're halfway done with the show, okay? So now implied earnings growth. Here we go. Implied earnings growth is the most sensitive factor when you value an investment, and we're going to see that. So earnings is important, but earnings growth is way more important, okay? Small changes in forecast earnings growth lead to big changes in value. Let's use the S&P 500 ratio to calculate implied earnings growth. Okay, now we're going to do some algebra. Okay, we're going to drive that. For those of you who are watching, okay, if you don't want to go through the derivation, you can go to slide 53. You can skip the next 9 slides and go to slide 53. But here's the derivation, and I'm going to kind of fly through it. This is algebra, okay? Thank heaven I could do this in practice before I did this presentation, because if I did this algebra live, I might muff it. But here we go. Here are the variables. We have price. That's the price of the index, okay? And we have earnings. We said trailing 12-month earnings. Here are our new variables. Here's the earnings rate. That's just earnings over price, okay? And we call it the required return percentage here. And we're gonna use a number that you're gonna recognize in a little bit for our required return percentage, okay? And G, that's the big G here, even though it's a little g. And the convention in finance classes is the growth number is a little g. The R number is a little g. And the price and E numbers are capital numbers. Not always, but often. So I use that convention. And what I like, though, is that R is a percentage and G is a percentage, whereas price and earnings are numbers and not percentages. So that's why I like the little numbers being percentages, the big numbers being real numbers, okay? So here we go. Growth is the average yearly growth, okay? Average yearly growth of earnings. So in other words, if you have earnings of $10 and they grow by 10%, you got $11 the next year. We'll see some of that math. Here we go. So Formula 1. Here's what the value is, the price of any investment. This is for finance class. This is a surprisingly simple equation, but that takes a lot of work to derive. We won't derive this equation. But the price of any investment that starts with an amount of earnings and earnings and the required return is a certain number, is just P, price equals earnings over the rate that's required. Okay, so this is the financial formula used to value any asset that will earn a constant amount, which is R, that R rate, each year forever. Okay, and the first equation they created was just for like the first year, and then they realized, wait a minute, if we do it forever, it's a much simpler equation than the one for doing it for just 1 year. Okay, so let's do an example. Okay, let's say that our earnings are $10 and our rate is 10%. Where did that rate, 10% rate, come from? Because it's our nice round number that we like. We're going to keep using that number. Okay. And the price then is, our equation says the price is E over R. So E is $10, R is 10%. And don't pull out a calculator, trust my math. I checked this 13 times for bad luck. And then I got $100. So yeah, now we have a slightly more important formula for today. Not slightly, absolutely more important. Now we have the formula adjusted for growth. And when you value an asset for which you have constant return and constant growth, the formula is a little more fancy. Instead of just taking that return number, you subtract the growth from it. If you're not an algebra guru, don't worry about why you subtract the G, because your eyes will cross and your head will blow up. But just trust that this is the financial formula that you used in every finance class. To value an asset, it's going to earn R%, but it's going to grow every year. E is going to grow every year by G. And here's our example. What if E is $10 again? Return is 10% again, required return, but growth is 1%. What is the value of that? Let's look at our formula. That's E over R minus G. So that's E, 10 over 10 minus 1, 10% minus 1%. That's 10 over 9%, and that's $111. So look what happened. No growth, and it was worth $100, all right? No growth. But now all we did was put 1% of growth in it, but look at the increase in the price of the stock. 1% of growth increased the stock price, if that were a share of stock, by 11%. This could be the whole market, though. That 10 could be 10 trillion. And that would mean at 1% growth could be $11 trillion of added value in the whole market if we just believe that growth increases by 1%. Okay, so now we're going to get really fancy with our algebra, and I'm going to go quicker here. If you can keep up with this, good for you, because I don't know if I could have had I not written this down. Here's our formula, but we're now going to change the formula because we want to be able to calculate G when we know the other three numbers. You'll see why. So to get G by itself, if you love algebra, watch this. Even if you don't, watch this. It's kind of magical. Notice that P is by itself, and we know what P is if we know E, R, and G. But we don't know what G is with this formula if we know P, E, and R, unless we reshape the formula. We're really going to just wiggle the formula around. It's going to end up being, honestly, the same formula, just rearranged. That's all we're doing. We're going to multiply both sides by R minus G. What that does is it cancels R minus G from the right side, but we multiply both sides. So now we multiplied the left by R minus G. Okay. Now we're going to rewrite P times R minus G on the left as PR minus PG. It works. Okay. Trust me. So now we have PR minus PG equals E. And we're going to add PG to both sides. Okay. Because we got PG subtracted on the left. Now we have PG added on the right. And we got rid of it on the left because we added it to both sides. So on the left it canceled, and on the right it appeared. So now we're going to subtract E from both sides. Now we have PR subtracted from the left side, but it was, added to the right side, It was added to the right side, and now it's gone. Now we're going to divide both sides by P, okay, and when G is by itself. So now if we know P, R, and E, we can calculate G, and I swap the sides. Now G is on the left. PR minus E all together divided by P gives us our implied earnings growth. Now we know P, E, and R, we can calculate G, and we can also calculate our price earnings ratio, okay? And we can set price earning at different levels to find G. Now, if you remember, that's what we're going for. We're looking at price earnings to see if we're comfortable with the growth rate that it implies. Okay, so we're going to say our return is 10%. We're going to do a table that shows implied earnings growth depending on PE ratio. Let's look at this. See that header? We're going to have price and earnings and required return, and we're going to have our PE ratio. So now based on PE ratio, we're going to see what kind of growth it implies, and we're going to look at growth because growth is a measure of human quality. All of these other things aren't measuring human quality really, but growth measures how fast we improve productivity, how fast we get better at what we're doing. Okay, so we got a formula down there equals, on the bottom left, G equals PR minus E over P. That's the formula we derived. Now we're going to assume R equals 10, and we're going to assume earnings are $1. And the beauty of assuming earnings are $1 is that the price equals the price earnings ratio. So here we go. Let's assume we have a price of $6.60, and if earnings are 1, let's go real slow, and our required return is 10, our price earnings ratio is 6.6. because price is $6.60, earnings are $1. So we've simplified this. This is as simple as it can get. So now we get to ignore PE and R, although they're going to be on the chart. We can look at only PE, price earnings ratio, and G, the growth. So the lowest it's ever been in December 48 at end of year is 6.6. And that actually implied that the market was going to shrink, that the earnings would shrink every year of the whole market. Now, what was happening there was at the end of 1948, the war had just ended, okay? And so there could be some mathematical quirky explanations for why it got really low at the end of a war, but that's the lowest it's ever been, okay? And then this implied, again, shrinkage, right? And in 1948, if you believe the economy would not collapse, you could have said to yourself, well, maybe prices are low and maybe it's a great time to buy stocks, and you would have been right, okay? Now, zero growth, okay, has happened a number of times throughout history, and zero growth is when the growth is zero, okay, and then the return, this is a little tricky, the return is the inverse of the ratio. So that might be confusing, but to make a long story, we'll try it. Okay, 10, the inverse of 10 is 1 over 10, and that's 10%, and that's our required return. So algebraically, if growth is going to be zero, you end up with a PE that equals the price. Okay, all right. And now, okay, here's the historical average. From 1927 to 2020, we saw the historical average was 17 times. And our implied growth, that's the number that we really take away from here, is 4.1 times, okay? So here's something to remember, though. When there's inflation of 2%, we'll use a 2% inflation benchmark. You really only made 2%, okay? 2.1%. So we've been ignoring inflation, but it's going to be important coming up. A little more water. Okay, so then... here we go. Today, we're at 25 times price earnings ratio. Okay. Look at that line. Price is 25, earnings are $1. Our return is 10% on all of them. And we've been filling out that formula, PR minus E over P. Okay. Says that our growth is 6%, even though the average is 4.1%. Okay. So again, the ratio implies 6% growth. And if we look at inflation, that's 4% growth, adjusting for inflation. Okay. The historical high was crazy. Okay, and that implied growth of 8, and that's not realistic. That's the quirk in this ratio, is that when you get trailing 12-month earnings that really drop like crazy, the ratio gets thrown off. But that's not where we are right now. We're not in a situation where trailing 12-month earnings have gone crazy and dropped off. Okay, they've been strong and healthy and steady. Okay, so here we go. Now what we're going to do is ask ourselves, do we really think this can happen? Now, this is a chart showing how often the ratio was at different levels, and it shows, if you look at the little blue numbers on the bottom, they go from 7, which is around where it's been the lowest it's ever been, to 71, all the way to the right, where the highest it's ever been. And then our implied growth is that next line. So historical low said our growth would be -5. Zero growth is at around 10 times PE ratio. The green one, average growth, is 17 times PE ratio. Okay. Now, today, we're at that red one, 6%, and that's 25 times PE ratio. And we look way over on the other side, historical high was around 9%, okay? All right. So here we go. Since 1927, the ratio was greater than today 7 times. We did this in the first slide. And it's less than today 85 times, okay? Remember, today, we're at that red. And look at the chart. The chart, by the way, just says how often. Okay, so let's look at the bar over the number 7. 4 times we've been around 7 times, because the bar goes up to the number 4 on the chart. Okay, so this just says how often, how many years that we've been around 7 times. Look at the one that's the tallest. 18 times we have been around 13. I think I said it backwards. 13 times we've been around 18. There it is. Pardon my dyslexia. Okay, so 13 times we've been around 18. So here we go. Now, if we believe we can sustain 25, we're saying we believe earnings will grow 6% per year. But let's think about that, okay? If the real growth rate on average was 4%, we take away inflation of 2%, and today we're implying real growth of 4%, okay? Do we believe that we can double our real improvement? Our real improvement, we have to adjust for inflation to know how much we really improve. Do we really think that we can double how fast we improve. That feels like a stretch, right? So how about maybe 5% growth instead of 6% growth implied today? Well, if we look at the chart, there's a number 5% there on the chart, and that's at 20. Okay. So in the artificial intelligence age, okay, we maybe can get 3% real growth, 5% growth on the index, 3% real growth. And so our implied earnings that we may believe is probably more like 20 times 5% growth. That one right there. Minus 2% inflation is 3% real growth. Instead of the 2% real growth that we've had in the past. These are rough numbers. We don't know what inflation will be, but it's been low. It's been in the 2-ish range for a long time, and maybe we'll continue to stay there. All these things, no one can really predict, but these seem like reasonable numbers when we look at that. So we're at our conclusion now. We've got 12 minutes to go, and we have probably gotten comfortable, I think, I hope, that we can't probably double average real productivity growth, but maybe we can get 5% growth, 3% after inflation. That corresponds to an a price earnings ratio of 20. Okay. But if we drop from where we are, 25 to 20, okay, that market capitalization will drop 5.6 trillion. This is what I said in the first slide. Okay. 19,000 per person for 320 million-ish of us in the United States. Okay. As an investor, here's what your implication is. Here's your bonus slide. If you stuck around to the end instead of leaving after the first slide, bonus, you get bonuses. Here's one. Okay. You're at record highs, ratio 17 times. Okay. If you stay in stocks, you're taking a lot of risk. So if you're neutral, risk neutral, you will, here you are. If you have it in a portfolio, you will sell stocks, sell long and medium term bonds, buy short term treasury bonds, and increase cash. Okay. Until your risk in your portfolio, because this will all lower the risk in your portfolio, gets to where you're more comfortable. Okay. And then that's a risk neutral investor, somebody who's the average investor. But if you really want to play it safe, you're risk averse, which is absolutely great. Nothing wrong with being risk averse. Then you're going to sell most or all of your stocks and bonds. And you're going to hold cash. You're going to come back and buy after if and when the market sinks. But if you're that risk averse, you may be in cash for quite a while, and you may watch other people make money while you don't. But that's what it means to be risk averse. Okay, so that's it. We've got to our conclusion, and really, I could have done this at the beginning here. I've done it at the end. I am not a broker, not an investment advisor, not a financial planner, not an investment manager, not a hedge fund or an investment bank. I do know the number of viewers in the first show. These are my notes, and I forgot to put this slide at the beginning. That's okay. And the number of viewers was altogether around 40 views. 8 viewers watched it live. 40 people watched the show, and they didn't watch the whole show. They watched about a half or a third of the show on average. Here we go. We don't make investment recommendations. We're unaffiliated with anybody. Okay. And now we'll go back to the beginning of this presentation. In fact, a quick way to get there will be to zoom up, tap on this, and go to here. This guy's really behaving well now. Okay. And now here we go. Your monthly investment statement, the sections it has. We have 10 minutes. Okay. So the first section on the left, let's go back here. Typically they have this. They have a latest month. Notice the red letters coming up toward the center in the middle. And they have since the year began, and this was a 6-month. This was a June 1st to June 30th statement, if you see the date on the top left. So this is what they do. They show you what happened in the last month and what's happened through the whole year. Okay. So this first section says where you started and what changed and where you ended up. Okay. That's different than the bottom section. Now, the top section and the bottom section have the same number at the bottom, but the bottom section shows more detail, and what it shows you is where you ended up. It ignores where you started. Okay. So it has more detail. I'll get into that. I have a table that's coming on the next slide, and we'll look at some of that detail. And then over on the right side, the bars are important. They show you what your value was of your whole account by the end of each month for each of the last 12 months. And this is everything, including cash in the account. Okay. And then we have this pie chart that really the bottom line behind the pie chart, and I got a big pretty pie chart coming up imitating this one, shows us how risky everything is. And when we're not used to looking at this, this is a lot of noise, right? So let's look at it with a little more patients a little more clarity. These are all the same numbers. I rounded them to the nearest dollar. They're the same numbers as in the chart, and I got them in dark blue here. And I won't go through. I'll start with 3.295 million. Okay, and we have cash value of what we bought. But notice what that's showing is cash going out. That's why it's a negative 6.8. My numbers in brackets are negatives. And a lot of times people don't know this. They look at a statement and they don't know the bracket means negatives, okay? And the numbers that are not in brackets are positives. So they take the top number and they subtract and add things to it to get to the next number, the next big number. They took away 6814 because cash went out. But what came in? What came in were the investments they bought. And there were withdrawals. Cash was pulled out of the account. So that gets subtracted from the value of the account. That's out of the account into some other account, okay? Just into your pocket. You could have taken cash out. You could have written a check on the account, okay? And then you have dividends that you receive, and you have that stock. Stock earns money, and some of the money the stock earns gets paid out in dividends, goes right into your account. Fees and charges are the fees you paid, which are very low here for commissions or for having the account. They're incredibly low in this account, but it's a big account, 3.5 million. So people who have large accounts get fantastic deals because the banks make money off of other services they give them. So, okay. Transfers mean transfers. No money got transferred in from some other account. Probably this investor has several accounts with the same broker, and they're transferring money because maybe different accounts have different strategies. One may be more risky, one may be more safe. Okay, and so they've got money reinvested. Okay, and that gets subtracted, and the investments got changed in value. They went up in value 45,928. So you got an ending value. You've got accrued income. Now here's what that one is. Let's see if I've got this here. So I've got that. The top section reviews changes, and the left column is for just the month, but the right column of the top section is year to date. Bottom section reviews current balances. And here's what I wanted to show you. That 5578 number, that's number that's not in your account yet. Okay. But they want you to know something. It's either dividends that were declared, because dividends get announced by companies that get declared, but it takes several days for the dividends to get deposited in everybody's accounts. And that's interest you've earned on those bonds you owned, but that hasn't been paid yet because companies pay interest typically once every 6 months. And so you buy a bond and you actually pay for the interest that's accumulated up to that date because the prior bondholder gets that. So when you buy a bond, you pay for all the interest that hasn't been paid yet that's accumulated on that bond, and then you get to receive the whole interest payment, right? Part of which, let's say you buy a bond halfway through when it's going to pay. Half that interest already went to the person who sold you the bond. You get all the interest, but you paid for half of it, and you keep the rest of it. Okay, that's how interest gets handled on bonds, and that's why it appears that way on that account. Okay, so here we go. The pie chart is to help you understand how risky your portfolio is. And let's understand something. For a lot of people, percentages are confusing. So let's look at this. A pie chart gives a visual representation. Stocks are riskiest. Bonds are less risky. Cash has no risk. Okay. In fact, cash does have a little bit of risk, but it's so small we don't have to think about it, because if it's in a bank, there are scenarios, right, where banks could fail. That has happened. In the modern economies, governments have been able to prevent that. That's another story for another day. Okay. In the end, we all end up paying for protecting those banks. Let me say it that way. But it's not a bad thing that we pay for that, right? Because if banks collapse, we'd be in huge trouble. All right. It would be like no roads on the road all of a sudden tomorrow, just dirt roads, just mud. It would be similar, if not worse. Okay. So then stocks are riskiest. Bonds are less risky. Cash is zero risk. Okay. What are percentages? 3% means, oh, I wrote it wrong. 3% does not mean $10 out of every $100. It means $3 out of every $100. There's an error. Okay, 38% means $38 out of every $100. Here's that pie chart. So I went back and used the numbers, and let's look at it, okay? So cash and money market are the most safe. 3% of that portfolio was in cash and money market. And when you look at their chart, it's the black section, okay? The next one was fixed income, which are bonds. See, here's something I wish weren't the case. They call them fixed income. A lot of people have never heard that expression. So they look at their statement, they see fixed income. They never look at it again. They've heard of bonds. Well, guess what? That's fixed income, because a bond, when you buy it, pays a certain fixed coupon. Okay. The only unpredictability in bonds and how much they're going to pay is if you decide to sell the bond before it matures, because bond prices change every day, and that's a topic for another story. Okay. Bonds with fixed coupons, with fixed interest payments, change in price every day. We got 4 minutes. Okay. And we're at the end. Okay. So Stocks. So this portfolio was 31% bonds. I think they have 32% in their schedule because I rounded the numbers, so it's close. Then they have 37% equities. I have 38% again because I rounded the numbers to make the chart. But we can see equities are the darkest shade here for me. I did this. They didn't use this pattern. To me, the darkest shade should have been the scariest shade, equities. But I really believe that they don't do that because they don't want to scare you. This is not that risky of a portfolio. But let's start over. Okay, 3% on the top is cash and money market. By the way, money market is just very short-term investments. Money market paper that you buy is like companies that borrow money literally for a week or a month or very short money for short periods. They're called money market investments. Okay, so fixed income and bonds are a little more risky. That's why I got them a little darker. 31% of this portfolio is that I'm calling that medium risk here. And then equities are the highest risk. That's a stock. So for a lot of people, the word equities doesn't mean anything. It's a stock. Equity is stock. Okay. And then you have funds in there. They call them bond funds and equity funds on that schedule. Okay. So that's 28% of this because they had 13. I'm looking at their schedule, 30% of equity funds and 15% of bond funds is 28%. All right. Now, we don't really know how risky those funds are. They're probably pretty safe because they're very diversified. But there are funds that are risky on purpose because people want to take that risk. Some people want to go for very high-tech new IPO companies, right? Or anything you can think of. Companies that just do laser, something that they're fascinated with that's risky. So you can buy an ETF or a mutual fund that is riskier. So that means that this part of the portfolio, we don't know right now with this detail how risky it is. How would you know? We would open it up. We would open up the other pages of this report and we would read fund by fund what's in there. Every fund that's in there in this account is in there, and then you can look up the funds. These funds may contain hundreds of names. What you can do is look up the fund with the ticker online, and you could probably do it on your own broker account, or you can do it in the fund manager's account, and you can see every share of stock and every piece of bond that's in there. This could be hundreds of items. And can you imagine the work it takes to manage all of this, to keep it rebalanced for you, and the work it would take you if you really did that work to make sure that they're not lying on this report? Well, guess what? There are accountants who do, what do we call it? Audit. They audit all of this, and they make sure by randomly choosing accounts to make sure that the company that gives you your report is really not lying. So that I put that red mark in there. I said fund risk depends on what the mix is of stocks and bonds. But in this portfolio, most likely they're medium risk, or maybe even less risk than the bonds. Bonds can be risky depending on how old they are. So that's it. That is the second MorAlpha show. Oh, something else I wanted to point out, and I still have a few seconds. I got a minute. The fees are in there, and for 6 months, these fees were $385 on $3.3 million. That was 0.01%. That's 2.02% per year. That's 0.02% per year. Normal fees are 1 or 2% per year, 100 times higher. Okay. How did this account perform? Not that well. It made $41,000 on $3.3 million, and it made 1.2% in 6 months. And that's 2.4% per year. Not very good. Not very impressive. And notice something. A lot of that change, in fact, that account was down 5,000 because it ended up at 4. Let me think. The account was up only 5. Let me think. It was up only. No, let me go. Oh, that's right. It was down 5. It was down 5. Here's why I know this. It was down around 5 because it made around 46. Okay. It made around 46, and then it ended up less than that. Ended up only at 41. Okay. That means it had lost 5,000. This account didn't do well. Okay. All right, that's it. That's the end of the show. Thanks for hanging out. Come on back next Monday. I put my schedule up. It's everywhere. It's on the web. It's on my Facebook page. It's on my YouTube page, and it's on my website. And thanks for hanging out with me. This is Al Mora. Remember, there's an investment revolution, and you and I are going to lead it. And we're going to do it by sharing knowledge and getting you into those. And we're getting into those. Notice something. Hang with me another minute. I cannot wait to teach you how to open your own investment account that has 0 minimum balance and 0 commissions. But notice something. I did this one first. I did not plan to do the price earnings ratio first, but I did this one first to caution everyone. If you haven't opened an account, when you get in, I'll show you a safe way to do it. I'll never tell you what to do, but I'll show you what's riskier and what's safe so you can decide how much risk you want to take. And now we're going to get into that in the next show. We're going to really look at what investments are and how risky they are. And that way, when you're opening your account, and we'll get into opening accounts, we'll get into very practical stuff, then you'll have some preparation for going in there and not just going in there and wondering, what in the world am I doing? You will have me as your guide. And of course, you can look for sources on the internet. There are YouTube videos, not as good as this one, all over YouTube, but you can also look, heck, for those of you who are young, are you excited about this stuff? Hang with me, because I'm going to take you down Wall Street. I'm going to take you places that you've never gone before, and they are, I think you're going to find fascinating, and I was there. All right, I'm going to check out now. Here we go. So thanks for hanging out with me, everybody, and have a great rest of your week. See you next week.